August started with a massive easy money bull run. Looking at the price action today, that momentum has suddenly slammed into a brick wall. Before we break down the data, remember that this analysis and the game plan I'm about to share are my personal expert opinion. I am not giving financial advice, and managing risk is your responsibility. This chart shows the S&P 500's recent movement. We had a steep, aggressive climb, but right here near the 7,691 level, that ascent flattens out into a choppy, sideways consolidation over the last few sessions. If we pull up the NASDAQ 100, we see the same thing. The upward momentum drops off, locking the index into a tight consolidation pattern right around 29,495. This is a market-wide stall. Looking at the Dow Jones, you can see it printing an identical flat pattern near 53,352. Large caps, tech, and the broad market are all suddenly stuck in the mud. So what are we looking at? Is this a healthy technical pause before the market breaks out to new highs, or are we seeing the beginning of a major reversal? Regardless of the long-term outcome, the directional trend we traded earlier in August is over. Navigating this environment requires a complete shift in immediate trading strategy. To understand why the major indices are stalling out, we must look past surface price action and check internal market mechanics to see where capital is actually moving. This heat map reveals stark internal divergence. High beta tech bleeds, while defensive sectors thrive. Top left, former rally engines like NVIDIA and AMD take heavy losses. Meanwhile, on the right, capital pours into steady, recession-resistant sectors. Healthcare giants and consumer staples are flashing green. Investors are executing a calculated rotation, harvesting gains from high-growth tech and sheltering capital in these defensive positions. This raises a logical follow-up question for traders. What specific event is driving those institutional funds out of growth stocks and into defensive positions right now? The immediate answer is a looming macroeconomic roadblock, the massive Federal Reserve data dump. We have a highly specific timeline ahead. Thursday brings the release of the FOMC meeting minutes, followed on Friday by a barrage of global flash PMIs. Institutional funds manage billions. They refuse to place heavy directional bets just days before the Federal Reserve provides guidance on future interest rate policy. The market is holding its breath, remaining paralyzed until the Fed signals the next path. Based on this data, tomorrow's session will likely be a chop zone. Expect low trading volume, tight price ranges, and a high probability of fake-out breakouts. That brings us to Rule 1 of our playbook: prioritize capital preservation. Trading heavily during a pre-FOMC consolidation usually results in a portfolio getting chopped to pieces. Holding cash is a perfectly valid active position. That brings us to rule number 2: avoid tech breakouts. We just saw that capital is actively migrating out of the tech sector. Because of that, trying to buy an upward breakout on the NASDAQ right now is stepping into a trap. And finally, rule number 3: execute mean reversion scalps. If you must trade, the only logical play is to buy off the established 1-hour support floors and sell at the resistance ceilings for quick, low-leverage profits. And as always, this playbook is my personal strategy, not financial advice. Right now, patience is your greatest weapon. Keep your capital safe in the chop zone so you have the ammunition ready to strike when the Fed finally dictates the next true trend.